Hey everybody, I'm here today with two really interesting, cool people, and we are going to be talking about the US market. And I think it's such a great time to be doing that because there's a lot of positive sentiment around the US market at the moment. So I am joined by Duane Gilbert, who's our Chief Investment Officer at Rise EasyRetire, which is fully owned by Easy Equities. It's a fund manager and an asset manager to a number of large companies, and through its managed bundle offerings on Easy Equities to retail investors. I'm also joined by Giulietta Talevi, who's an amazing financial journalist who also presents Stockwatch on Business Day TV. So thank you guys for being here. I really appreciate your time.
Thanks, Carly.
Thank you.
So let's get into it, guys. I'm thinking about last year. There was a lot of negativity around the US market. Some people thought we were headed for a recession. There was lots of doom and gloom. And yet the S&P 500 returned over 23%. What do you think made people feel more optimistic than fearful of the markets? What do you think drove that?
Would you like to go first?
No, I was waiting for Duane, the expert, real expert in the room, to go first.
All right. So, I mean, if you look at the S&P 500 index, the headline returns are a bit misleading because it's a very large cap tech dominated index. So you have almost 27% of the index made up of the 7 large tech stocks: Facebook, Google, Amazon, Apple, Nvidia, Tesla, and Microsoft. And those stocks did more than 100% as a group in 2023. And clearly that was a tech-specific phenomenon. It wasn't a reflection of the economy. And I mean, we can go into that if you like. But if you have 27% of the index doing 100%, it sort of tells you that the rest of the index did nothing. And that, I think, is a bit more of a truer reflection of the economic situation last year. But that said, towards the end of October and into November, December, we did see a more broad-based rally as the US inflation numbers came progressively closer to the Fed's target. But the key driver for markets was the tech phenomenon. It wasn't the interest rates or inflation numbers coming down as much.
But Duane, isn't it always the case that you actually, I mean, I'm an observer in a way on Stockwatch on Business Day TV, and I chat to a lot of people, and isn't it always the case that you only ever have a few shares that lead you up during a kind of a so-called bull market, which you could arguably say what was in place last year? Before the subprime crisis, it was the banking shares. Back in the early 2000s, it was the first wave of tech stocks. So, I mean, do we need to get that worried about the fact that it was quite concentrated in a handful of shares?
Yeah, well, the thing is, the world's changed quite a bit. If you go back 10, 15 years, maybe South Africa was very concentrated because of the gold shares, but global indices were a lot more diverse. And, times have changed where large companies have just become larger and larger, and they've pretty much captured the market. So, I mean, seven stocks, I don't think that's a good indication of where the market is when you look at the equally weighted S&P 500 index, and that was roughly flat for the year.
So let's talk about the Magnificent Seven that you've mentioned. What is the sort of long-term outlook for these stocks and the tech sector in general? Do we see this continuing indefinitely, or has there got to be some point where it drops?
Look, sorry, please go ahead.
I mean, Duane, I suppose from my perspective is that you've got kind of big companies that are just getting bigger, and I personally can't see them getting smaller anytime soon until there's some sort of regulation in the States that might break up, these big monolithic structures. And the point about them is that most of them, maybe barring Tesla, have phenomenal balance sheets. They've got so much cash, so they can just hoover up smaller companies that then add to their own businesses. They can pay, they can even pay dividends. I mean, Meta paid a dividend, or announced a dividend a couple of weeks ago, which was quite a surprise and a sort of an indication of maturity and also financial robustness. So I can't really see these companies diminishing in size. But I suppose maybe the one thing that they will attract is more competition. So people will start coming for them, because they play in such a lucrative space. I mean, if you look at NVIDIA, you will get other companies. I think Microsoft is trying to do a deal with Intel to lessen its reliance on NVIDIA. And I think maybe that's what's going to change the game. But I personally don't see these companies losing their dominance anytime soon. But maybe I'm wrong.
Yeah, I mean, I'm not tech expert. In fact, sometimes I've been called a caveman, so I don't really want to act like I'm a tech expert. But I think what we saw in 2023 was a lot of excitement around the AI theme, and a few new products that were brought to market, and some new efficiencies. And I think with AI, the sky is the limit. And I think the market has it correct that the large cap players with the good balance sheets are the ones investing in AI technology, and they're the best positioned to benefit. So there's no reason to say that because they've done so well in 2023 that they can't potentially replicate that performance again in 2024. But the way I always view things is from a portfolio construction perspective, and the economic outlook for 2024, and we can get into that in more detail if you like. But one of the things that concerns me is the potential.
We've lost you there,
Possibly
Duane.
the middle of to the end of. And one thing I always say is it's very dangerous. Oh, I'm sorry about that.
That's okay.
So I said, in terms of the economic outlook, there's a good probability that there will be a US recession sometime this year. I'm not saying that it will definitely happen, but one thing I always say is that, when markets turn down, it's very dangerous to be holding expensive stocks. And equally so, when markets turn up, it's very dangerous not to be holding cheap stocks. So, you have the Magnificent Seven. According to FactSet, there's a forward-looking PE of 35.5, which is just about double where the rest of the index is. And so potentially, if we have a downturn in the economic environment, your defensives will potentially do a lot better than your large cap tech. So from that perspective, I think it's prudent to sort of trim your exposure to the large cap tech. But if you have a strong view on these companies on a possibly a longer time horizon than 12 months, then I'll say definitely keep them in your portfolio.
I mean, Carly, I've seen some comments that NVIDIA is actually cheap.
Wow.
And it's hard
Okay.
to conceptualize that when a stock has done what it's done in the last couple of years, and the kind of but it's based on its earnings because it can't keep up with demand. It massively increased its revenue forecast. So on a historic earnings basis, NVIDIA trades on a PE of 60 times. On a forward basis, as Duane said, well, it's 33 times, so it's a little below the average for the whole sector. But if they do even better than they themselves are saying, you could say that actually their price to earnings ratio should be lower than that. And then maybe there is an argument to be made for them being cheap, although I don't know if any value investor would call a stock trading on a PE of over 30 cheap. But I mean, this is the conundrum I think that people are battling with.
Yeah.
If the AI game is just that big and there's just so much demand for the next 2 years, well, companies everywhere scramble, to get their technology, I suppose, AI fits. It's going to be huge demand for these players. So, and if they can't keep up with that demand, it's going to translate into really fat earnings and I guess even fatter cash balances.
Yeah.
And just on NVIDIA, we saw a very interesting short squeeze last week. as well, because a lot of hedge funds trying to call the top and shorting the stock. And, what that means is eventually they need to buy back that stock to close their short position, and they end up pushing up the share. And that really pushed NVIDIA to new all-time highs.
I was actually sitting with my mum last week, I think it was Monday or Tuesday, and we were talking about investing in US stocks because she hadn't invested yet. And she was like, I've just heard so much about NVIDIA. I really want to invest in that stock. And I've been listening to podcasts about it. And I said, okay, cool. Let's make that the first stock you invest in. And so she invested in on Monday or Tuesday. And on Thursday, it shot up 15%. She was so happy. She was like, yes, I'm making such good decisions. I was like, yeah, it's pretty cool that happened. So I find it quite interesting, Duane, that you are saying that the US markets could go into recession this year, because a lot of analysts are saying that we're in a bull run. And I was thinking, sort of what's the outlook on that? How are we feeling about a bull run this year? And can investors anticipate a drop in interest rates? So maybe just talk a little bit more about your thoughts there.
Yeah, so I would say we probably in the late stages of a bull market. I think certainly, the Fed has guided for interest rate cuts in 2024, and the market is expecting interest rate cuts as well. And I think certainly as those interest rates come down, you'll have a repricing in risk assets. So your equities will do well and your bonds will do well as well. And that will, I'm sure that will push the S&P 500 to new all-time highs. But that's just a re-rating in the valuation. It's not a driver of earnings. Maybe it is a bit of a tailwind for earnings in some of the small caps, but I don't think it's going to have much of a significant impact on earnings in the large caps. It's more just a repricing of risk. And then, will there be a recession this year? I mean, I really don't know. I mean,
no one does, right?
No one does. Historically, US recessions have always been preceded by very aggressive interest rate hikes. And this hiking cycle that we've seen over the past 2 years has been the most aggressive in the past 40 years. So it is reasonable to suggest that there'll be a recession or a huge slowdown in growth. But I think the Fed is actually also ahead of the curve. Usually the Fed is quite reactive and behind the curve. And I think we might have a very new scenario where the Fed actually starts cutting rates before growth slows significantly. And that might cause markets to sort of brush off the recession and power ahead. So I think certainly, for the next 3 to 6 months at least, I'm positive on global equities. Past that, I'm not necessarily negative, but I'll be a bit more cautious.
My feeling from and please take it from whence it comes. I'm not an economist, and I said I'm not an expert, but and as an observer, it's quite interesting to hear the perpetual talk of recession. It's almost as if a lot of people are willing a recession to happen, almost because they want the Fed to cut interest rates. Because even if it's a recession, you almost think it might just be a technical recession. In other words, a recession defined as 2 consecutive quarters of negative growth. Because you've got a US economy where you've had wage growth finally after many, many years where you didn't have that. You've got practically full employment. You've got companies doing well. You've probably got productivity gains. So all these things, and you've got a consumer in fairly good nick. So these are not the signs of an economy in dire trouble. This is not an economy like South Africa. So when you talk about recession, it's almost more of a technical aspect that it strikes me that traders are worried about or willing into being, because they want the Fed to cut interest rates, because that would kind of spur another market rally. Maybe that's my cynical point of view, but I battle to see how, with so many strong metrics underpinning the US economy, that you should regard it as an economy that in danger of very weak growth.
No, I agree with that. And to your point, the bank balance sheets are looking pretty good, and so are consumer balance sheets, and the housing market is looking pretty strong as well. So the idea of a severe recession, I mean, I don't think that's a likely scenario, and it might be more of a mild recession, more of a technical recession. But I think again, when you have equity markets trading at very high multiples, they could be quite sensitive to those small changes, and that could just present another buying opportunity to get back in.
I love those buying opportunities. Giulietta, when are the US elections taking place? That's happening this year, right?
Yep, in November.
In
So
November.
it's a race between the old and the old.
Yes,
yes. Well, it looks like it at this stage, with Trump doing very well in the Republican primaries. His competitor Nikki Haley seems to be falling behind. So it looks like it'll be a Joe Biden Donald Trump rematch.
Well, there's still a ways to go to November, so yeah, here's hoping. What do investors need to think about in terms of that event? How could this impact the markets? Is there anything strategically they should be thinking of ahead of that?
I'm not sure that they should really be overly concerned. I mean, if Donald Trump comes thumping back to power, the one thing that a lot of people are worried about are his sheer unpredictability as a human being and a president, and potential protectionist measures, so a trade war against China. But it's hard to see exactly how that would play out necessarily with a lot of companies, or a lot of the big companies that have led the charge on markets. There's some concern that if there was a trade war, it would lead to slower global growth, which would be bad for oil prices. But you're really extrapolating a few scenarios. So I'm not actually sure that you need to be overly worried about who wins the elections. I think that's maybe, it's got deeper political ramifications and social and maybe cultural issues. But in terms of companies doing what they do, I'm not sure. I feel like the impact is kind of marginal. I don't know, Duane, if you disagree with me there.
Yeah, no, I do agree with you for the most part. I'll say, in theory, they say if a Republican candidate wins, they tend to have more market-friendly policies, and that should be supportive of markets. But historically, if you look at how markets have behaved after U.S. elections, there hasn't really been a big difference between whether the Democrat president or a Republican president wins. I'd say, certainly if Biden wins, I wouldn't expect anything to change, because, the Democrats already have the presidency, the Senate, and the House of Representatives. So, anything they want to do, they could have done already. The thing with Trump is that he was a bit of an exception. Markets did rally quite strongly after Trump's victory. Like him or not, a lot of his policies were very pro-market. So he introduced some very big tax cuts, tax reforms. He did away with a lot of old regulations that he saw as impeding small businesses. He renegotiated trade agreements, and obviously he took on China as well. And that made everybody very nervous of the time, but it was very controlled. So I think certainly if you think Trump is going to win, you can expect him to reintroduce all those measures, and you can pick your stocks accordingly.
But interestingly, I was looking at an FT article in preparation for our discussion today. Under Trump, the S&P 500 was up 56% over his tenure. Under Joe Biden, it's up 48% so far. So far, his tenure isn't over yet. So there's not actually, that goes to show that there's not much in it. And there's also, what's in it are all the other things affecting the economy, like COVID and all sorts of other things, and the direction of interest rates. So it's it would be very hard to pinpoint, I think, any one a percentage of those gains or losses to the one presidential candidate that's going to come out.
Yeah, I agree.
It's a bit of a
And
witch's cauldron. It's not just one thing, right? There's so many different things that can influence it.
yeah, but I guess, instead of trying to think of it in terms of the whole market, you can think of it in terms of your portfolios and your stock picks. I mean, some of these policies are going to be headwinds for certain counters. I mean, if you're going to have trade wars with China, you're going to potentially rethink your stocks that have a large exposure to China going into the election. So I think you have to be very sort of practical in how you implement that.
So,
Rather than broadly saying I'm getting out of equities because Trump is going to win, for example.
So you mentioned China, both of you, and I think historically the US has introduced sanctions, for example, limiting tech companies like NVIDIA from doing business with China. How do sanctions like this impact the markets?
Probably more so from the Chinese perspective, and you've seen Chinese stocks sell off quite severely in the last 18 months. I mean, they have huge internal issues. They've got this property boom and now bust, huge amounts of debt in their property sector, and property was a source of wealth, and if that sector of the economy is really weak, it's going to have a knock-on effect on everything else. But I think there's a lot of fear about China's own internal policies, which is why a lot of foreigners would have pulled out money from Chinese equities. So I suspect that maybe it's as much China's own internal issues. But yeah, I mean, sanctions are never really great for markets because they impede the free flow of trade.
Yeah, and I think again you have to be. It's a very stock specific impact. So I mean, obviously, if you introduce sanctions on NVIDIA, you would expect that to directly impact the NVIDIA share price. Not that it did, but the government has responsibilities. Other than just being market friendly, and I think this AI race is a really big deal. I mean, it has huge implications for cybersecurity and all of those things. So the government is prioritizing that the US and US tech needs to win that tech race. So this policy is specifically aimed at not enabling Chinese companies to compete. Whether it'll be effective, I don't think so. I mean, I don't think it's going to be that difficult for them to replicate the technology since they have it in front of them. But that's the spirit of it, and I don't think that is badly received as a concept.
And in terms of other sort of global events that are taking place, the Israel Palestine conflict that's still going on, how does that impact the US markets, if at all?
So far the impact has been quite muted. And that's because, Israel and Palestine are not significant trade partners to any of the major economies, and they aren't really oil nations or oil exporting nations. So far the impact has been muted, but I'm not blind to the possibility that the reality that the situation is escalating, and it could involve other countries like Lebanon and Iran, and suddenly, and that could then involve the US, and I don't know in what capacity, but that could potentially lead to oil supply disruptions in the region. So you've already seen oil prices climb a bit in response to that, just pricing in the possibility of that happening. But I think, other than the direct impact on the oil price, you will have what we call a risk-off trade. Generally, in a risk-off trade, investors flock away from what they perceive as risky assets, which includes, emerging markets, emerging market currencies, and they flock to safe haven assets like the dollar, US bonds, and even gold. So, if you are concerned about geopolitical risks, having US bonds in your portfolio is a good idea.
The irony, of course, is that if everyone flocks to the US dollar, it's not good for the rand. And you'll probably be thinking, damn it, I should have taken my rands out earlier because it's weakened again. But I think you've got to maybe just look past that and say, you know what, I want to buy shares in the world's strongest economy. These are the powerful companies of the world. I'm buying the company. I'm not overly concerned about the currency, but it probably will have a negative effect on the rand, which of course then influences your own offshore buying decisions. But I think you've got to try and look past that and think, what am I doing with the rands that I'm taking offshore? I'm buying great companies, and that's my primary motivation.
And I suppose that speaks to diversification in your portfolio as well, as if you have both local and offshore investments, you kind of reap the benefits on either side and make up for the losses on the other side. So yeah, diversification is important. You spoke about oil companies, Duane. I'm just thinking about the US and its move towards renewable energy and whether that's potentially also in the short term or long term going to have an impact on the success of oil companies and what kind of impact that has.
Look, so I just want to start by saying that I'm a huge proponent of renewable energy, particularly in South Africa to meet our energy deficit. In my capacity as portfolio manager, I've funded the renewable energy projects since REAP Round 1 was announced in 2011. And but that said, I think globally, the reality is that the modern world runs off fossil fuels. That's how the modern world was built, and that's how infrastructure was built. And the reality is that it's just too cheap and too easy to pull oil out of the ground versus renewables, which is quite technical. It requires design and environmental studies, and it requires grid connection, grid capacity, and the impact that you can have with renewables is very localized to that grid infrastructure. So that said, I think the game changer in renewables is going to be green hydrogen. So green hydrogen is basically using renewable energy from green sources, wind or solar, and basically separating the water into its oxygen and hydrogen components. That hydrogen is, very easy to transport, very easy to store, and it can be used to generate electricity. It can be used to power ships and vehicles and planes, and it's more of a commodity. You can produce it in mass and transport it to wherever it needs to be in the world. And the green hydrogen technology is there, and we're seeing very low levels of adoption, but I think watch the space. It's going to be a game changer. And I think countries like South Africa and Namibia, if we want to get onto this train, we're very well positioned. Through the Northern Cape, through the coast in Namibia. You have access to the ports. You have very strong solar resources. And I think if we're serious about it, we can really capture that market.
Yeah, it's exciting, and it's probably inevitable. We need to sort of be forward thinking in that area. Giulietta, did you want to add anything?
No, I was just thinking of, I mean, yeah, that's the Holy Grail. But you can see that it's going to take a while to get there, and you can see that from Sasol's as a case study. They talk about using feedstock, which is like in this case gas or coal to produce fuel, and they produce grey hydrogen, so not green hydrogen. It's not environmentally friendly, and to get to green, it's going to cost them a lot more money to produce the fuel that we demand. We would have to pay a lot more for it. So if we can get that technology right so that the cost comes down, then that would be fantastic. But we're not there yet. But I think Duane's right. you've got to be, companies have got to be throwing kind of everything at it to try and get sort of the feedstocks for energy to be environmentally friendly and at a reasonable cost, where you can say, okay, maybe they're at an equivalent, to fossil fuels, or maybe there's a slight premium on green hydrogen, but because of the environmental benefits, that's the one that you would go for.
Makes it worth it.
But we're not there yet, and that's one of the issues that Sasol, as a sort of a case study in this, is grappling with.
Okay, great, guys. Well, I think we're going to end things there. Thank you so much for your thoughts and insights. I hope this offers some nice context for all of our investors out there. Any closing remarks, anything that we haven't chatted about that you think is worth mentioning?
I think stay invested. Duane made a comment, and you made a comment about the elections. Don't pull your cash out because you're afraid of any one event. I mean, it was, and an example that we have in recent memory is COVID. What happened to the markets there? If you were overtaken by fear and dumped all your stocks, and then maybe didn't get back in, you missed out on a massive rally. And I think you just got to stay invested, and maybe you change what you're invested in, but stay the course. That is, that's the secret to building up long-term wealth.
Yeah, I agree. It's not about timing the markets, it's about your time in the market.
In the market. Yes.
Yeah.
Warren Buffett's a big fan of that as well. Okay, great, guys. Thank you so much. Really appreciate the session, and have a good one.
Thanks, Carly.
Thank you.
Cheers, guys. Bye.
Cheers. Bye.